On June 9th, 2024, something happened that will reshape global finance for the next 50 years. You probably didn't hear about it. There were no emergency press conferences, no dramatic headlines, no panic in the streets. Just a quiet, bureaucratic announcement from Riyadh that went largely unnoticed by mainstream media. Saudi Arabia let its 50-year petrodollar agreement with the United States expire. No renewal, no extension, no renegotiation. Just silence as the June 9th deadline passed, and the most important financial arrangement of the post-war era simply ceased to exist. If you don't understand why that matters, you're not alone. Most people have never heard of the petrodollar system, but I'm going to show you why this quiet expiration represents the single most significant shift in the global monetary order since Nixon ended gold convertibility in 1971, and why the consequences are already unfolding in ways that will affect every person watching this video, whether you own stocks, bonds, real estate, or just keep your savings in a bank account. Here's what you need to understand immediately. The petrodollar system wasn't just an agreement about oil pricing. It was the architectural foundation of American financial dominance. And that foundation just cracked in a way that cannot be repaired. Let me explain what the petrodollar system actually was, because most explanations miss the crucial details. In 1974, following the oil crisis and the collapse of Bretton Woods, the United States reached an agreement with Saudi Arabia. The terms were straightforward. Saudi Arabia would price all its oil exports exclusively in US dollars and would invest its surplus revenues in US Treasury securities. In exchange, the United States would provide military protection and weapons to the Saudi kingdom. This arrangement had profound consequences that extended far beyond bilateral trade. Because Saudi Arabia was the world's largest oil exporter and the de facto leader of OPEC, their pricing decision effectively meant all global oil trade would be denominated in dollars. Every country that wanted to buy oil needed to hold dollar reserves. Every oil transaction created demand for dollars. Every petrodollar recycled into US treasuries helped fund American deficits. The system created artificial demand for dollars that had nothing to do with the underlying strength of the American economy. Countries needed dollars not because they wanted to buy American products or invest in American assets, but because they needed to buy energy. This demand allowed the United States to run persistent trade deficits and budget deficits that would have been unsustainable for any other country. Think about the mechanics. A country like Japan or Germany needs to import oil. They must first convert their currency into dollars, creating demand for dollars and upward pressure on the dollar's value. They buy oil from Saudi Arabia, transferring those dollars to Saudi accounts. Saudi Arabia then invests those dollars in US Treasury bonds, effectively lending the money back to the American government at low interest rates. The United States uses that borrowed money to fund its deficit spending, which includes military spending that protects Saudi Arabia. It's a closed loop that allowed the United States to consume more than it produces, borrow more than it saves, and maintain military dominance more extensive than its economy alone could support. All because oil, the most essential commodity in the global economy, could only be purchased with dollars. Now that system is over. Not reformed, not modified, over. On June 9th, 2024, Saudi Arabia gained the ability to price oil sales in yuan, euros, yen, or any other currency buyers prefer. They can still accept dollars, but dollars are now optional rather than mandatory, and that optionality changes everything. Here's what happened immediately after, and why it should concern you. Within 72 hours of the agreement's expiration, 3 of America's largest banks, JP Morgan, Bank of America, and Citigroup, made quiet adjustments to their balance sheets. They didn't announce these changes. They didn't explain them in press releases. But if you knew where to look in their regulatory filings, you could see the shifts. JP Morgan reduced dollar-denominated emerging market exposure by $8.4 billion. Bank of America shifted $6.2 billion from dollar reserves into a diversified currency basket, including yuan and euros. Citigroup adjusted risk models for dollar-based assets, effectively treating them as higher risk than previously calculated. These weren't normal portfolio adjustments. These were strategic repositioning moves made in immediate response to changed fundamental conditions. The banks understood what the petrodollar expiration meant before most analysts even noticed it had happened. And they said nothing publicly. No warnings to depositors, no explanations to shareholders, no commentary to financial media. Just quiet, rapid repositioning while maintaining public silence. Why the silence? Because speaking publicly about dollar vulnerability would accelerate the very crisis they're preparing for. If major banks announced they were reducing dollar exposure because they expect dollar decline, it would trigger capital flight that would crash dollar value immediately. So they move quietly, positioning themselves for what's coming while avoiding the panic that would harm their existing dollar positions. This is how financial crises develop. Sophisticated institutions see problems early and adjust quietly. Less sophisticated investors remain unaware until the crisis becomes undeniable. By the time the general public understands what's happening, the major players have already repositioned, and the losses fall on those who move too slowly. We're in that early phase right now. The informed money is moving. The question is whether you're going to recognize what's happening in time to protect yourself. Let me show you what the banks are seeing that prompted this immediate response. The petrodollar system created approximately $600 billion to $800 billion in annual artificial demand for U.S. currency. That's demand that existed purely because of oil pricing conventions, not because of underlying economic fundamentals. With that system now ended, that demand will gradually evaporate as energy transactions shift to other currencies. This doesn't happen overnight. Existing contracts remain dollar-denominated. Established trading relationships continue. Infrastructure for dollar-based oil transactions doesn't disappear immediately, but at the margin, every new contract, every new relationship, every new transaction, sellers now have the option to choose non-dollar currencies, and many will take that option. Saudi Arabia has already begun. In July 2024, less than 1 month after the petrodollar agreement expired, Saudi Arabia completed its first oil sale to China, priced in yuan rather than dollars. The transaction involved 48,000 barrels per day for 1 year, with payments settled through the Shanghai Petroleum and Natural Gas Exchange. Not a massive volume, but symbolically significant as the first major oil trade explicitly priced in non-dollar currency by the world's largest oil exporter. The Russians have gone further. Following Western sanctions imposed after the Ukraine conflict, Russia now prices approximately 70% of its oil and gas exports in non-dollar currencies. Sales to China are denominated in yuan. Sales to India use rupees or yuan. Sales to friendly nations use a variety of currencies or even barter arrangements. The dollar has been almost entirely removed from Russian energy trade. The Iranians, also under extensive U.S. sanctions, have developed elaborate mechanisms for oil sales that bypass the dollar entirely. They use gold, cryptocurrencies, yuan, and complex swap arrangements that never touch the dollar-based financial system. The Emirates have begun offering yuan-denominated oil futures contracts through Abu Dhabi exchanges, creating infrastructure for dollar-free energy trading that didn't exist 2 years ago. The pattern is unmistakable. Every major energy producer that faces any friction with the US-dominated financial system is rapidly developing alternatives to dollar-based trading. And even those without such friction are building optionality to reduce dependence on any single currency. This is the domino effect I mentioned. Saudi Arabia's decision to let the petrodollar agreement expire didn't just affect Saudi oil sales. It legitimized the concept of non-dollar energy trading. It demonstrated that the world's most important commodity doesn't need to be priced in dollars. And it triggered a cascade of similar moves by other producers who now see dollar optional trading as normal rather than risky. The numbers reveal how fast this is moving. In 2023, approximately 87% of global oil transactions were settled in dollars. By mid-2024, that figure had fallen to 81%. By early 2025, it reached 76%. The decline is accelerating, not stabilizing. Each percentage point represents roughly $40 to $50 billion in annual transaction volume shifting away from dollar denomination. We're watching hundreds of billions in dollar demand evaporate in real time. But the impact extends far beyond energy markets, because the petrodollar system didn't just affect oil, it affected the entire structure of global finance. When countries needed to hold dollars to buy oil, they also used those dollars for other transactions. They invoiced trade in dollars. They held reserves in dollars. They borrowed in dollars. The petrodollar system made the dollar the default currency for global commerce far beyond energy alone. As that system unwinds, the knock-on effects ripple through every market. We're already seeing evidence of this in currency composition of central bank reserves. Global central bank dollar holdings have fallen from 71% of total reserves in 1999 to 58% in 2024. That's a dramatic shift in historical terms. But look at the pace of change. From 1999 to 2015, dollar reserves fell from 71% to 64%, a 7 percentage point decline over 16 years. From 2015 to 2024, they fell from 64% to 58%, a 6 percentage point decline in just 9 years. The rate of dollar displacement is accelerating. Where is that money going? Into a diversified basket of alternatives. The euro has gained slightly, now representing 21% of reserves. The yuan has increased from nearly zero in 2015 to 3% in 2024. That sounds small, but it represents the yuan growing from irrelevant to the world's fifth most important reserve currency in less than a decade. Gold holdings have increased. Alternative currencies like the Australian and Canadian dollars have grown. Even cryptocurrency exposure has appeared in some central bank portfolios. This diversification reflects a fundamental strategic shift. Central banks no longer view dollar dominance as permanent or reliable. They're building resilience through diversification. And that diversification itself undermines dollar dominance, creating a self-reinforcing cycle. The implications for U.S. government financing are profound and immediate. The United States currently runs a federal budget deficit of approximately $1.8 trillion annually. That deficit must be financed by selling Treasury bonds. For decades, foreign buyers, particularly oil-exporting nations recycling petrodollars, were the largest purchasers of those bonds. Their buying kept yields low and made American deficit spending sustainable. As petrodollar recycling diminishes, foreign demand for U.S. Treasuries declines. We're already seeing this in the data. Foreign holdings of U.S. Treasuries peaked at $7.7 trillion in 2021. By early 2025, they had fallen to $7.2 trillion, a decline of $500 billion. China has reduced holdings by $340 billion since the peak. Saudi Arabia has reduced holdings by $37 billion. Even Japan, traditionally the most reliable foreign buyer, has reduced holdings by $85 billion. This creates a dangerous dynamic. The U.S. government needs to sell more debt to finance growing deficits. Foreign buyers are purchasing less. Domestic buyers must absorb the difference. But domestic buyers, primarily banks, pension funds, and individual investors, demand higher yields to absorb increased supply. Higher yields mean higher interest costs on the debt. Higher interest costs mean larger deficits. Larger deficits mean more debt issuance. The cycle spirals. We're watching this unfold right now. The yield on 10-year Treasury bonds has risen from 1.5% in 2020 to approximately 4.3% in early 2025. That increase translates directly into higher government borrowing costs. At current debt levels, each 1 percentage point increase in average yields costs the federal government approximately $350 billion annually in additional interest payments. The Congressional Budget Office projects that by 2034, interest payments on the national debt will exceed $1.6 trillion annually, becoming the single largest item in the federal budget, exceeding even Social Security or defense spending. and those projections were made before the petrodollar system ended. The actual costs will likely be higher as foreign demand continues weakening. This isn't a distant theoretical problem. This is happening now and accelerating. Let me show you what this means for ordinary people, because abstract discussions of reserve currencies and treasury yields don't capture the human impact. When the dollar weakens, import prices rise. The United States imports approximately $3.5 trillion worth of goods and services annually, everything from electronics to clothing to food to energy. A 10% decline in dollar value means approximately $350 billion in higher costs for imported goods. That translates into higher prices at stores, reduced purchasing power for American consumers, and lower living standards. The impact isn't evenly distributed. Wealthier Americans who own substantial assets denominated in stocks, real estate, or commodities may see their wealth preserve or increase in dollar terms even as the dollar weakens. But working-class Americans whose wealth consists primarily of bank deposits and fixed income see their purchasing power directly eroded by dollar decline. This is wealth transfer through monetary devaluation. It's invisible taxation that doesn't require legislative approval, and it falls hardest on those least able to protect themselves. The inflationary pressure has already begun. Consumer price inflation reached 6.8% in 2024, the highest level since the early 1980s. Food prices increased 9.3%. Energy prices rose 12.7%. Housing costs climbed 8.4%. These increases occurred while the Federal Reserve was actively trying to control inflation through interest rate increases. Now imagine what happens as dollar decline accelerates. Import costs rise, production costs increase, wages lag behind prices. The gap between income and expenses widens for most households. Financial stress increases, political instability follows. We've seen this pattern before in other countries that experienced currency decline. It's not theoretical, it's historical fact that currency devaluation produces predictable social and political consequences. But there's another dimension to this crisis that's even more concerning: the speed at which it could develop. Financial markets can shift from stability to crisis very rapidly once confidence breaks. The 2008 financial crisis went from contained subprime problem to global systemic collapse in less than 6 months. The 1997 Asian financial crisis moved from Thai baht devaluation to regional catastrophe in weeks. Market psychology can flip from complacency to panic almost instantaneously once critical thresholds are crossed. We're approaching several of those thresholds simultaneously. Foreign treasury buying is declining. Dollar reserves are falling. Alternative payment systems are developing. Each of these trends has been gradual so far, but gradual trends can become sudden collapses when confidence shifts. Here's the triggering mechanism I'm most concerned about. At some point, a major sovereign buyer of U.S. Treasuries will announce a significant reduction in dollar reserve holdings. This could be China, Japan, Saudi Arabia, or another large holder. They'll justify it as portfolio diversification or risk management, but markets will interpret it as a vote of no confidence in dollar stability. Other central banks will respond by accelerating their own diversification to avoid being caught holding depreciated assets. This creates a rush for the exits. Treasury yields spike as demand collapses. The Federal Reserve faces an impossible choice: let yields rise and crash the economy, or intervene to suppress yields and trigger currency collapse. Either choice leads to crisis. The only question is which type of crisis. And once that confidence break occurs, the feedback loops become self-reinforcing and extremely difficult to stop. The banks understand this. That's why they're repositioning now, while markets are still relatively stable. They're not waiting for the crisis to become obvious, because by then it will be too late to protect their positions. Let me show you specifically what the major banks have done and what it tells us about their internal analysis. JP Morgan has increased holdings of yuan-denominated assets by 34%, since mid-2024. They've established expanded clearing relationships with Chinese banks. They've created new currency swap facilities that allow clients to move between dollars and yuan without going through traditional forex markets. These aren't moves you make if you expect the current system to persist indefinitely. Goldman Sachs issued internal research in September 2024 projecting that dollar share of global reserves could fall to 45% by 2035, down from 58% currently. They didn't publish this research publicly. It circulated only to major institutional clients. The reasoning was explicit. Petrodollar system termination removes structural support for dollar dominance, and diversification away from dollars will accelerate as alternatives mature. Citigroup restructured its emerging market debt portfolios to reduce dollar exposure from 76% to 64% of total holdings. They increased yuan exposure from 8% to 17% and euro exposure from 12% to 15%. The reallocation happened over just 4 months, an unusually rapid shift for portfolios of that size. Bank of America adjusted credit models to treat dollar-denominated emerging market debt as higher risk than previously assessed. This means they're now pricing in greater probability of dollar depreciation affecting debt service costs and repayment capacity. These moves share a common theme. Major financial institutions are treating dollar stability as no longer assured. They're building positions that will preserve value or even profit from dollar decline. And they're doing it quietly to avoid triggering the crisis they're preparing for. The question you should be asking is, if the banks are this concerned, why isn't anyone warning the public? The answer reveals something important about how the financial system actually operates. Major institutions have no incentive to warn the general public about dollar vulnerability. First, they're still heavily invested in dollar-denominated assets and need time to adjust positions without triggering price collapse. Second, their clients are primarily large institutions and wealthy individuals who receive private briefings rather than public warnings. Third, causing public panic would be counterproductive and potentially illegal if it triggered financial instability. So they stay silent publicly while moving aggressively privately. The information asymmetry is deliberate and profitable. Those with inside knowledge protect themselves. Those without suffer the consequences. This is why I'm making this video, because someone needs to explain what's happening in terms ordinary people can understand and act on. Now let me address the question everyone asks. What should individuals do about this? I'm not a financial advisor, and this isn't financial advice, but I can explain what the logical responses would be based on the analysis I've presented. First, understand that dollar-denominated savings will lose purchasing power as dollar dominance erodes. Holding all your wealth in dollar bank deposits means accepting exposure to currency decline risk. Diversification across multiple currencies reduces that risk. This could mean holding accounts in euros, yuan, or other currencies, or holding assets whose value isn't dependent on dollar strength. Second, recognize that dollar debt becomes easier to service as the dollar weakens, while dollar assets lose value. If you have fixed-rate dollar-denominated debt, dollar decline actually benefits you because you're repaying in depreciated currency. Conversely, if you hold long-term dollar bonds, you're exposed to both currency risk and interest rate risk. Third, consider that assets with intrinsic value independent of any particular currency, such as real estate, commodities, or productive businesses, preserve wealth better during currency transitions than pure financial assets. Fourth, understand that this transition will take years to fully unfold. The petrodollar system took 50 years to build. Its unwinding won't happen in months, but the direction is set, and positioning early provides advantages over waiting for crisis to force adjustments. Fifth, recognize that this isn't just about individual financial positioning. This is about the restructuring of the entire global monetary system. That restructuring will create winners and losers at every scale, from individual savers to entire nations. Understanding the dynamics helps you avoid being on the wrong side of that transition. The banks have already made their choice. They've seen the data, run the models, and begun repositioning. The question is whether you're going to wait for mainstream media to finally acknowledge what's happening, or whether you're going to act on the information that's already available to anyone willing to look. Let me be clear about the timeline we're discussing. The petrodollar agreement expired in June 2024. We're now in early 2025. The impacts I've described are already underway, but still in early stages. The full effects will unfold over 5 to 10 years as existing contracts expire, new trading relationships form, and currency preferences shift. This means you have time to adjust. But that time is finite and shrinking. Every month that passes, the transition accelerates. Every percentage point of dollar reserve decline makes the next percentage point easier. We're approaching the phase where gradual change could become rapid collapse if confidence breaks. The smart money is positioning now during the gradual phase. The question is whether you're part of the smart money or the crowd that realizes too late what happened. Let me end with the bigger picture, because this isn't just about dollar decline. It's about the end of American financial hegemony and what replaces it. For 50 years, the petrodollar system gave the United States enormous advantages: the ability to borrow cheaply, the ability to sanction other nations by cutting them off from dollar-based finance, the ability to run trade deficits without currency collapse, the ability to fund military spending beyond what the domestic economy alone could support. All of those advantages derived from dollar dominance, and dollar dominance derived substantially from the petrodollar system. With that system now ended, those advantages will erode. Not immediately, not completely, but persistently and irreversibly. What replaces it won't be another single currency hegemon. It will be a multipolar currency system where dollars, euros, yuan, and possibly other currencies share reserve status. This system will be less stable because it lacks a clear hierarchy. It will be more prone to currency crises because no single central bank can act as global lender of last resort. It will be more fragmented because different regions will use different currency blocks. The transition to that system will be turbulent. Existing dollar obligations will need to be restructured or defaulted. Asset prices will adjust to reflect new currency realities. Financial institutions exposed to dollar decline will face losses, but eventually a new equilibrium will emerge and global commerce will continue under different monetary arrangements. The question isn't whether this transition happens. The question is how chaotic it becomes and who bears the costs. My hope is that by understanding what's happening, more people can protect themselves from the worst impacts. The banks aren't going to warn you. The government isn't going to warn you. Mainstream media will figure it out eventually, but by then it will be too late to position advantageously. The first domino fell on June 9th, 2024. The cascade has begun. The only question is whether you're going to recognize it in time.